Europe during the 15th century was not a great place to be a peasant. Peasants were the workforce. They toiled daily through heat and cold, through ache and pain in the farmland. Through taxes, tithes, and rents, nobles took over half of the peasants' produced wealth for themselves. For the majority of Europeans, this was life. It was lived day to day. After all, it was hard to think about what to save for the winter when a family did not have enough to eat during harvest season. Saving even a handful of grain was not a common practice, as it would likely be stolen by an opposing nation's army. For the majority of Europeans, there was no financial security or even a well-functioning financial system. Nobles as well as the church were dependent upon the work of peasants. Without their farm work, the economy would collapse. While peasants labored, nobles profited off of them. As European countries became more interconnected, so did their economies. Trade extended beyond single nations, and mercantilism became the predominating financial philosophy throughout Europe. It was believed that the wealth of a nation was directly related to the amount of precious metal that that country possessed. Further, it was believed that there was a set amount of metal as well as a set amount of goods. Therefore, if one country were to gain wealth, it was unavoidable that it should be at the loss of another. The attachment to precious metal also heightened piracy. Of course, the most prosperous country was the most powerful. Because this financial system depended on the losses and gains of other countries, it intensified nationalism. It was necessary for a country to export more than it imported. The external trading developed into new systems. This was the beginning of monopolies, a forceful approach into the New World. This system was highly tangible. Physical commodities were being traded for physical metal. Today it may seem simplistic, but mercantilism increased the need for industrial work. Nations no longer thrived solely off of agriculture. Mercantilism opened Europe to industry, new ideas, and as an economically joined continent. Churches and monarchs needed a way to protect their accumulating wealth. The infamous Medici family of Florence, Italy, capitalized on this opportunity and found a solution to this problem by opening their first bank in 1397. Giovanni Medici, bank founder, rapidly profited and opened numerous banks across Europe in a matter of months. Of course, problems arose. Management was a major issue. It was difficult to find reliable people who could successfully run a business. The banks had a great amount of wealth under one roof. Banks decided to issue portions of that wealth to those who needed it in exchange for an interest rate. This was the beginning of debt and equity. After an unbelievable century of wealth and power, the Medicis began making unwise decisions which ultimately led to their decline. Too many people were never able to repay their debt. The Medici family never received the money they had lent or the added interest. Thus, they were unable to return it to the church and the monarch. They had a slight problem when they could not repay the most powerful people in Europe. The loan sharks of Glasgow gave rise to usury. People who were looking to start a business needed money fast. They went to the loan sharks who lent the money. However, they were charged an unreasonably high interest rate. This was morally corrupt. These lenders ruined the lives of many who could not repay their loans and who would be indebted for the rest of their lives. During the 12th century in France, there were certain people who helped the banks regulate the debts of agricultural communities. They were very similar to present-day brokers. The bank would offer them some sort of payment, and in exchange, the brokers would make sure debts were collected. In the middle of the 13th century, Venetian bankers began to trade in government securities. They could invest in certain governments in which they thought would grow in the near future. As trade grew, inside trading and financially influencing others became more prevalent. The Venetian government was quick to outlaw spreading rumors about governments in 1351. As all of this was happening, the Dutch East India Company, one of the largest corporations at the time, became the first joint stock company. People were now not only able to invest in governments, but able to invest in corporations as well. With more methods of investing, the market grew. Insurance was popularized in Europe during the Age of Exploration. Sending ships to explore the world came at a great economic expense, and often only one that monarchs could afford. As settling in foreign areas of the world became more commonplace, ships became a means of transportation for everyday people. Ships were not flawless, and sometimes they sank. The owners often could not afford a sunken or even damaged ship, so that risk would be taken over by someone else. The owner would make a payment to the insurer in return for a guarantee that the insurer would pay for anything that happened to the ship. The insurer benefited from this because oftentimes ships would survive unharmed and the insurer would turn an easy profit. Other times, money was lost, because a repair was needed. Insurance became a greater need with the Great London Fire in 1666, which destroyed over 13,000 homes. No one could afford the loss of a house, and so they insured their homes in case of another such disaster. Insurance became more popular as more possessions could be insured. During the Age of Exploration, Europe was growing to be a financially complex continent. Previously, almost the entire economy was dependent upon the work of peasants. While peasants still toiled, they did not bring in the only revenue. Mercantilist philosophy made industry a more important part of European culture. Banking and the stock market opened more financial opportunities. Finally, the birth of insurance secured personal wealth as well as joint wealth. These financial systems ultimately connected the economies of the European nations.